Alibaba. Scary stock for a lot of people, not for me. It is down big time in the last year and a half. But remember, guys, one of the things I keep repeating over and over in this community, the more you know, the less you fear. 20 years ago, when I didn't understand why stocks went up and down, I was scared of stocks. I thought I was an expert. I wasn't. The more I understood stocks and their financial statements and the company, the less I feared. So let's get into Baba right now. We're going to go to our 8 pillars. And remember, guys, if you belong to our software, if you're one of the 12,000 people who've signed up, please follow along. And you probably know all about our holdings in Baba in terms of how we look at it. Guys, it got as low as $73 lately. And now it's at 105. This thing's all over the board. Hit 120, 105, etc. But it hit a peak of $310 back in October of 2020. So a year and 9 months ago. So 500-foot view, almost a $300 billion company. Okay, no dividend. Let's go check out the 8 pillars. Pillar number 1, we want the 5-year PE to be under 22.5. It is right here on the main page, 19.4. So we have a check mark there. Pillar number 2, we want the 5-year return on invested capital greater than 9%. This tells us how well are they investing the money that's invested in the business through debt and equity. It's right here on the main page, 11.1%. Check mark there. All right, so far, 2 check marks. Pillar number 3, let's go to the income statement. Because our 3rd pillar is revenue growth of the last 5 years. So 5 years ago, $37 billion. Last year, $128 billion. So, guys, look at this. The company's actually selling for pretty much where it was when it IPO'd. It IPO'd when it had like $3 or $4 billion in revenue or something small. It's now $127 billion. If you believed it was worth it all along the way, this is crazy. The revenue is up almost 4 times in the last 5 years. Pillar number 4, net income growth. So we just scroll down. And guys, remember, I know these financial statements can seem very intimidating. They are not. Trust me on this one. The more you know, the less you fear. You will learn as part of this community. If you've joined, and if you haven't joined, watch more videos, join the community. You'll learn more as time goes on. Everybody's there to help each other. 5 years ago, $9.6 billion. Last year, $8.2. So it is down with record revenue, though. They're spending a lot of money. Where are they spending it? So we scroll up a little bit. A couple of billion-dollar charges here. A couple of multi-billion-dollar charges. So they're taking on some charges right now. They have the tax issue with China, etc. So their income is down a lot. But we'll look more about that in the future because their revenue is up $20 billion last year, but their profit was down. Not exactly in line. Pillar number 5. Guys, this is an important one. So many people ignore this pillar. That's why I made it a pillar. Dilution, shares outstanding. We want shares outstanding going down overall. 2.54 billion. Now they have 2.68. That's an X. Shares are going up. Now, is that always a bad thing? No. But overall, the problem with dilution is you are now getting lower and lower percentage of the revenue and profit. This is not up a lot. This is not up a ton. 2.54 to 2.68. It's less than 5%. And we'll look at it more in the 8 pillars tab, but it's not a big amount, but I don't like it when companies just use it as a way of funding other businesses and diluting the people who've stuck with them. Now, pillar number 6 has to do with long-term liabilities. I have found that debt to a company is like debt to a consumer, to you and I, the average person. The reason being is I want to sit there and find companies that could withstand shocks. So I sat there and decided, okay, I'm going to go back to the main page. And on the main page, I have a metric in here for the 5 years of average free cash flow. It's right here, about $20 billion. I multiply that by 5. And I want their long-term liabilities to be under $100 billion. When I looked at all the data, I sat there and said, this seems reasonable to me. So then I go to the balance sheet of our software. I go to annual. Annual. Scroll all the way to the bottom. Long-term liabilities, $34 billion. Guys, this is such low debt. If they just replicate the last 5 years, they can pay it off in 1.75 years. And last year they did $40 billion. They could have paid it off in 9 months, 10 months. This is incredible. Our final 2 metrics have to do with free cash flow. Guys, remember, free cash flow is the lifeblood of every business, okay? So guys, free cash flow is cash from operations less your capital expenditures. Based on how China reports, we don't have the most recent data because it has not been sent to us by our data provider. But let's just go to the previous year. Free cash flow was $28 billion versus 9.8. That's a check mark. Now, Our next and final metric, we take the average of the last 5 years free cash flow, 20 billion, we multiply it by 22.5. This gives us a market cap to start with, kind of like PE, right? So 20 billion times 22.5 is $450 billion. Okay, so we want the market cap under $450 billion. Let's go back to our main page and see what it was. Very simple, guys. Main page, scrolling down, 293 billion. That's a check mark. So just to give you a recap of where everything is, we're at the 8 pillars page. We only have 2 X's. Net income is down, which we knew, and shares outstanding are up. Okay, fine. Does that mean we don't buy the company? Of course not. Let's go into the stock analyzer tool, which has been our most popular part of our software. And let's just actually do the numbers. So, revenue growth. I'm going to be conservative with Baba. Let's say 6, 9, and 12% revenue growth. Keep in mind, guys, they did 35.9 last 5 years each year, and last year they did 19%. Profit margin. Remember, they had a big fluke year of profit margin, so I'm going to go back and focus on I'm going to go 15, 17, and 19. Free cash flow margin, boy, I'm going to do 17, 20, and 23. PE, 14, 16, and 18. Why did I go a little bit higher? Guys, it's China, fast growing, fastest growing economy in the world, huge middle class growth. I love it. I want to be involved with that. Price of free cash flow, same thing. And my desired return, 12.5%. Now, this one you can alter based on whatever you want. The reason I picked 12.5% is if you look at historical, 9 or 10% in a low-cost ETF that matches the market. So give yourself a margin of safety and a reason to buy an individual stock. I hit the analyze button. The stock is currently 106. We have all greens. We have a low price of 107, just a little bit above where we are today, and a high price of 295. So again, before you go hit the buy button, go understand, because there are risks associated with China. Could they take the stock off the stock exchange? There's all these risks that involved. You have to be comfortable with those risks, but that's why you join the community and have the conversation. We have a specific China and Alibaba chat within our community where people talk about this. Because remember, guys, the more you know, the less you fear. And the more knowledge you get, the more people you talk to, the less you will fear, and you will make less mistakes when you fear less. Now, this 8-pillar process, if it makes sense to you, click on our next video, just learning more details about our 8-pillar process so you can understand it better and fear it less.